The 5 best dividend paying companies to buy in July 2020. What is happening, investors? It is your boy Jack. I'm not a financial advisor, and today we're actually going to speak about dividend stocks. It's been a while. As of late, I've been speaking a lot about, some higher risk companies, SPACs in particular, LCA, your Helions, BurgerFi, things of the likes. And on the other hand, there's been a lot of big blue chip companies like Facebook and Amazon. So today, I want to show some love to my dividend investors, man. I will be honest, I'm not adding to my current dividend positions as of right now. I just have my priorities in other sectors. But I am going to speak about 5 companies today that I think are at a good price as a long-term dividend investment, all of which I do indeed own and do plan on investing more in at some stage, potentially by the end of the month. And we're going to go through 5 different sectors as well, so they're not all just going to be in the one sector. They're not all real estate, they're not all financials, they're all different kinds of companies. And the 5 companies we are going to cover today are Altria stock, ticker symbol MO in the consumer staples category. JPMorgan Chase & Co, okay, ticker symbol JPM in the financial sector. Third up we have Qualcomm, ticker symbol QCOM, and they are in information technology. Fourth up today we have Realty Income Corp, ticker symbol O, and they are in real estate. And last today we're going to have a look at Pembina Pipeline, ticker symbol PPL, and they are in oil. So right before we get into the very first choice of today, can I please ask you to smash a like on this video? It helps me out so much. If you're new around here, please subscribe. We upload every single day and we are so close to 10,000 subs. I cannot wait to hit that. And drop me a comment down below, let me know some of the dividend paying companies that you are looking to buy this month in particular. And with that being said, guys, let's get into our very first company of today, Altria. As of right now, Altria is the 8th biggest position in my portfolio, okay? And it's actually my biggest holding in a dividend company, or a company that I buy purely for the dividend. I own Apple, for example. They're my second biggest holding, but I don't own them for the dividend, even though they do pay one. So it goes without saying that I very much so do like Altria as a long-term dividend play. So a few of the basics right off the bat, okay? A dividend yield currently of 8.5%. A dividend safety of 55, so it's borderline safe. Not the best in the whole wide world, okay? And then they have an uninterrupted dividend streak of 50+ years. Now, personally, I think this dividend is quite safe. As I just said, they've been growing that dividend for 50+ years. That makes them a dividend king. And I think we all know that that makes a company very attractive. And what's further, okay? They pay out currently 75% of earnings as a dividend. Now, this payout ratio is edging towards the high side, but look, it's been around this all the way back since 2010, and they've managed just fine. Now, when we look at Altria, I think it's very important to have a look at the 5-year chart and to acknowledge the fact that it has been going down for a couple of years. Essentially, for 3 years, we've been on a downtrend, okay? In 3 years, down nearly 50%. In the last 6 months, from the highs to where we are now, down 22.78%. So if you don't know what these guys do, they're America's largest tobacco company. And there's been less and less people as a percentage smoking in the US for the last 50+ years. So you would think right off the bat, Altria couldn't have had a good 50 years. Well, if we go back to 1980, from there up to their peaks, over the span of less than 40 years, they returned over 19,000%. So they performed absolutely fantastically. Now, as a percentage, there's less people smoking, but obviously there is a lot more people living in the US today, and the price of cigarettes has obviously gone up, which has kept Altria alive. What's really exciting about Altria to me personally though, okay, is they are involved in a lot of up-and-coming industries. They have a $1.8 billion investment for 45% of the cannabis company Cronos. You all more than likely know who these are. A $12.8 billion investment for 35% of the vaping company Juul. Now, this hasn't gone particularly well, but it still could. A 10% investment in ABInBev, the global beer industry leader. They sell wine, okay? They're in global heated tobacco products. They're in oral nicotine pouches. They're getting into a lot of these up-and-coming markets. And they've proved that they don't need the percentage of smokers to go up in order for this company to do very well. The fact that they have an 8.5% dividend, and they've had such a rough few years, and they're getting into recently so many new emerging markets, really does make me love these guys, and that is why they're the biggest dividend company in my portfolio currently. If you want more information on Altria, I do have a full video on these guys, so it'll be in the top corner of the screen right now if you want to check that out. But I don't want to drag this video out, so that was company number 1, Altria. Second up today, we are looking at JPMorgan Chase & Co, a bank stock. Companies in the financial sector right now, okay, have some of the lowest forward PE ratios, okay? The S&P 500 index has a forward PE ratio currently of 21.5. The average in the financial sector of these companies is at 14. So that would imply that they are cheaper to buy at their current prices than a lot of other companies in the S&P 500. Even things like consumer staples are at 19.3, healthcare at 15.9. Financials are some of the lowest PE ratio companies out there. Now, if you've watched the channel before, you'll know that I am in Wells Fargo. The reason I'm speaking about JP Morgan, okay, is because I fully acknowledge that JP Morgan is a safer, then Wells Fargo. And if you watched the full video I made on Wells Fargo in the past, you may remember that I said I wasn't buying them for the dividend, okay? I see Wells Fargo as the potential at these price points to go up hundreds and hundreds of percent in a matter of years when things start to go good again. Wells Fargo have said that they expect its third quarter dividend to be cut from its current level. I expected this to happen. This did not come as a shock to me. Today we're speaking about dividend stocks in particular, okay? And if I was to buy JPMorgan, it would be to buy them as a dividend paying company with very close currently to a 4% yield. Now the thing is, guys, okay, investing in any financially rated company right now for its dividend does carry some risk, okay? We can see with JPM even in the past, 2009, 2010, they had to completely cut their dividend, okay? But when they bring it back and grow it quite aggressively. I mean, last year, a 25% dividend increase. You will not see that very often. And the thing is, okay, over the past year, JPM has paid out 32% of its earnings as a dividend, okay? So that's a safe payout ratio. You would expect them to be able to keep up this quite reasonable dividend. And I don't think they'll want to cut it again. Again, I could well see a world where they cut their dividend either completely or half it or something along the lines. Especially when we see that the earnings payout ratio is expected to be 57% over the next 12 months. Historically though, they've done a fantastic job of keeping it below that 40%, around the 30% mark. I will say that I most certainly think it's a lot safer than Wells Fargo. I'm going to make a full update video on bank stocks very soon, so I'm going to keep it short and sweet. When the economy does well, bank stocks will do well, and when the economy is doing poorly, bank stocks will do poorly. We go back to the Great Recession and we can see that JPM fell over 65% in value at one stage. And then they went on this absolutely incredible 10-year run, returning over 760% from the bottoms to the very highs. And now we see again that they've been hit very hard, still down close to 33% in a market where most companies are only down 5-ish%. The S&P is down about 5%. I understand financial stocks aren't for everyone, bank stocks aren't for everyone, but for me personally, I will be investing in these guys a little bit more relatively soon. Right now I hold a very small position. And that's where I'm going to leave JPMorgan. I'm not going to get too into it because I will make that full update video within the next week. Okay, we're speaking about Qualcomm, and I know they only have a dividend yield of about 2.83%, but I think that the growth potential these guys carry alongside that dividend yield makes them an absolutely fantastic pick. These guys are potentially the biggest play on 5G technology, period. Relatively new to paying a dividend, okay? 16 years. But they did survive the Great Recession, okay? And the last 10 years, they've grown that dividend at an average rate of 14%. There's been some really nice growth in there. On the 6-month chart, okay, these guys, you know, they had their dip like everybody else, but they have also made a fantastic recovery, which you have to love to see. And they are currently at all-time highs and show no signs of wanting to slow down. 5G is a massive part of the reason that I would be happy to buy this company, because I think there is some nice growth potential for the company in the short term, medium term, and long term. I mean, there's always going to be new technology coming out. And what I really like, okay, is that they have this deal with Apple, okay? Apple is going to be using Qualcomm chips for their 5G phones. And a lot of people use Apple products, okay? Apple disclosed that there were 1.4 billion active devices in the installed base as of January 2019. That was up 100 million over the preceding 12 months and 400 million over the preceding 3 years. A lot of these products are being bought every single year, and the amount that are being bought is only going up, which is going to be good for Qualcomm. I don't know about you guys, but I don't want to bet against 5G. From a practical point of view, a lot of people have the newest phone nowadays. You know, these phones are a massive part of our life. You're probably watching this YouTube video on a phone right now. Maybe you're watching it on a Mac. And I, for one, know that when 5G is out, I am going to get a 5G device. It is that simple. But also, it's just the fact that I believe in the company's growth. That dividend is such a nice bonus. And it's not a particularly low dividend either. It's okay. And if they keep growing at this rate, one day it's going to be a very nice dividend. Okay, fourth up today. This is one that a lot of you guys love. It's everybody's favorite REIT. It is Realty Income Corp with a dividend yield of 4.59%, a dividend safety of 70, and an uninterrupted dividend streak of 25 plus years, which, let me tell you, for an REIT is extremely rare. So this one's a little bit weird for me, okay, because I don't particularly like investing in big stores or big chains at the moment. And what Realty Income does, okay, is they own more than 6,400 properties across America that are leased to about 300 commercial tenants in 50 different industries. So what I do like is how so very diversified they are. If anything goes wrong with one of these businesses, one of these companies, it won't affect Realty Income all that much. They still have a whole lot of other tenants. Now, it is retail properties that generate 83% of their rental revenue. Again, I'm not particularly happy, or I'm not particularly looking to invest in individual retail units. But if it's a whole lot of different ones combined together, I can deal with that. And the thing is, for Realty Income to do well, they just need these tenants to pay their rent. They don't need these tenants to be successful. I mean, they need them to not go bankrupt and they need them to be able to pay their rent, but it doesn't really matter if things are somewhat slow for the other companies. As long as they keep paying Realty the rent, we should be okay as investors. Now obviously, in the world we live in right now, a lot of places weren't able to pay their rent, but Realty Income did a lot better than a lot of other REITs, which fills me with confidence going forwards. They collected more rent in April than other retail REITs that have reported so far. They took in 83%, the next company took in 70%, so they have done well. I'm looking at a company with a decent 5-year stock chart. I mean, it had its lows, it started to bounce back, and then we just got hit terribly. I mean, we dropped down as much as nearly 50%, okay, and we still are down 25.89%, which is part of the reason I feel it's a good buy. It's one of those ones where when we have a look at the max stock chart, it's just been constant, slow and steady upwards growth in the grand scheme of things. This, in my eyes, is a real dividend paying company. You know, you don't buy these guys because you think they're going to go up 100% in value. It's just not realistic. Not in a span of a few years anyway, like you could potentially expect from other companies. You buy them because they're a company who pays a very nice dividend, has a good history of doing so, can clearly survive tough times. And they also do, in general, go up in value, which is always obviously very important too. What's the point in making dividends if you're going to lose more on the actual company's value, on the shares that you own? I do like them. I haven't found an REIT that I like as much as these guys just yet. I like being diversified. I will probably buy more of these soon. I do only have a relatively small position in these guys, but I'm up 17%, and you know, like when you're up that much, it's hard to invest because then the cost basis goes up and it goes from being up 17% to up 8%. It's a weird thing. You haven't actually lost money, but it feels like you have. But anyway, one more company to cover today. Pembina Pipeline, baby. A 7.5% dividend yield with a dividend safety of 80. That is great stuff. Now, right off the bat, they only have a dividend growth streak of 8 years, but they do have an uninterrupted dividend streak of 23 years. It is what it is. They only pay out 54% of DCF as a dividend. That's fantastic. And even the next 12 months, it's expected to be in a good position, so I would expect this dividend to be safe. I'm sorry if you don't know who these guys are, okay? They're a major transportation and midstream service provider with a network of oil and gas pipelines, storage facilities, and processing plants located primarily in Western Canada. And these guys have a great stock chart, okay? They've gone up and up. Here, when they went down 2014 to 2016, there was an energy crash in these times. So we can see from peaks to very lows, they lost about 57% of their value, okay? Another midstream related stock that I really like, Enterprise Product Partners, okay? And you can see the same. If we go to the max stock chart, we can see this crash from 2014 to 2016, and they had something similar, okay? We go from the highs to the lows, 45+%. So this wasn't anything done wrong by these guys whatsoever. It was circumstantial. Every time there's ever been a normal period of time, they have slowly but surely grown up and paid out that dividend. And since that crash, they went ahead and they kept growing, you know what I mean? Again, it's not the fastest in the whole world, but it is very, very respectable. I mean, 100+% in 4 years is very good. Then we take a spin over to the 6-month chart, and again, they got hit heavy, down 70% in value, my days. And as of right now, still down very close to 40% in value. One of the reasons I do particularly like Pembina, even opposed to EPD, because these guys, if you know me, I am invested in these guys. I'm down a considerable amount. I'm not upset about it. I will probably double down on my position very soon. If we hit a $17 mark, I am doubling down. Debt levels are in a good place, okay? And as of right now, they've recorded total assets of $24 billion, which is an above average amount for pipelines. On the balance sheet, we see current assets of $656.6 million. Total assets, as we just said, $24.2 billion, okay? Current liabilities, $1,083 million, and then we have total liabilities $11.9 billion. So from a long-term point of view, their balance sheet is absolutely beautiful, which means I don't have to worry too much about the short term. In my eyes right now, I just feel like they're at a fantastic price point, especially considering where the dividend yield is at currently. And they are the 5 dividend companies, people. So hopefully I was able to put a company onto your radar today, or at least just, you know, refresh your memory, just because I know I haven't spoke about dividends lately. I wanted to make a little video for you guys to let you know what I am actually looking at right now. The main reason I'm not looking at dividends too much as of late is because I find it very hard to find ones where I'm happy with the price that they are at. But the ones we spoke about today, I do think all of them are at quite nice prices. Now that definitely doesn't mean that they don't have room to go lower. I just think from a long-term point of view, they're at a very good place. If you enjoyed this video and you have watched till the end again, please smash that like, please subscribe if you're new around here, and please drop me a comment down below. Those 3 things genuinely are what make this channel grow. I appreciate you all so much. I really do hope you have an absolutely fantastic day. I will see you for tomorrow's video. Peace.